Silver's sharp pullback explained and why stackers shouldn't panic. 1. Silver's sudden price swing. Silver experienced one of its most dramatic short-term price movements in recent years. In the span of just a few trading sessions, the metal surged from the high $50s per ounce into the mid-$60s, a move that immediately captured attention across financial markets. For many observers, the rally appeared almost vertical, fast, aggressive, and emotionally charged. Then just as quickly, silver pulled back sharply, erasing a meaningful portion of those gains in a single day. Such violent price action tends to create confusion, especially among investors who are not accustomed to the unique behavior of commodities markets. Rapid upside moves often trigger narratives of shortages, panic buying, or structural breaks in the system. Likewise, sharp pullbacks tend to spark fears of manipulation, bubble collapses, or failed breakouts. In reality, silver's behavior this week was far more mechanical than emotional, driven largely by market structure rather than a sudden change in fundamentals. Silver is not a typical asset. It sits at the intersection of monetary metal, industrial input, and speculative trading vehicle. This combination makes it particularly sensitive to flows in derivatives markets, especially futures contracts. When momentum builds quickly, leveraged participants can amplify price moves far beyond what physical supply and demand alone would justify in the short term. That is precisely what happened during the initial surge. The pullback that followed should not be viewed as a repudiation of silver's broader trend. Instead, it reflects the market's tendency to correct excess leverage after a rapid move. When prices accelerate too quickly, the system often responds with friction, margin adjustments, profit-taking, and forced position reductions that temporarily halt momentum. For physical silver holders, this distinction matters. A short-term pullback following a steep rally does not invalidate the reasons many people hold silver in the first place. It does not signal a collapse in industrial demand, nor does it suggest that silver's monetary role has suddenly weakened. It simply highlights how price discovery in modern markets often occurs through paper instruments rather than physical exchange. Understanding this context helps reframe the volatility. Rather than asking why silver failed to hold recent highs, a better question is whether anything fundamental actually changed. In this case, it did not. The underlying drivers, currency debasement, industrial usage, constrained mine supply, and long-term investor demand, remain intact. What changed was the cost of leverage, and with it, the behavior of short-term traders. In other words, silver's sudden price swing was dramatic, but not mysterious. It was the predictable result of a fast-moving market interacting with a highly leveraged trading environment. 2. What triggered the pullback? The immediate catalyst for silver's pullback was not a collapse in demand or an unexpected surge in supply. Instead, it was a technical adjustment within the futures market, an increase in margin requirements, also known as performance bond requirements, for silver futures contracts. Margin is the collateral traders must post to control a futures position. Unlike buying physical silver, where the full value of the metal must be paid up front, futures trading allows participants to control large quantities of silver with relatively small amounts of capital. A single silver futures contract represents 5,000 ounces of silver, yet traders only post a fraction of the total value as margin. This leverage is what makes futures markets efficient, but also volatile. When an exchange raises margin requirements, it does not change the contract itself. The size of the contract remains the same, and the underlying silver does not suddenly become more or less valuable. What changes is the amount of cash required to maintain a position. Traders must either add capital to their accounts or reduce their exposure. In a calm market, margin hikes often pass with limited impact. But in a fast-moving market, especially one that has just experienced a sharp rally, margin increases can have outsized effects. Traders who are already stretched by rising prices may be forced to liquidate positions quickly. Others may proactively reduce exposure to avoid additional capital commitments. The result is a sudden wave of selling, often compressed into a very short time frame. This is exactly what occurred during silver's pullback. Large volumes of futures contracts were sold in minutes, creating the appearance of overwhelming supply. However, this supply existed almost entirely on paper. No equivalent amount of physical silver was dumped onto the market. Instead, leveraged positions were unwound, driving spot prices lower through futures-linked price discovery. It is important to note that margin hikes are not inherently bearish. Exchanges typically raise margins when volatility increases, not because they believe prices are unsustainable, but because they want to reduce systemic risk. Higher margins dampen excessive leverage and help ensure market stability. Ironically, the very act of raising margins to control risk can trigger short-term volatility. For observers unfamiliar with futures mechanics, this can feel counterintuitive. Prices drop sharply without any obvious change in real-world conditions. But within the structure of derivatives markets, it makes perfect sense. When leverage is reduced quickly, price adjustments can be abrupt. Crucially, this type of pullback does not represent a loss of confidence in silver itself. It reflects a recalibration of speculative positioning. Once leverage is flushed out, markets often stabilize and resume trading based on broader fundamentals rather than forced liquidations. Understanding this distinction is essential. The pullback was not a verdict on silver's long-term value. It was a mechanical response to tighter financial conditions within the futures market. 3. Understanding silver futures and leverage. To fully understand silver's recent price action, it is necessary to understand how silver futures work and why leverage plays such a central role in price movements. A silver futures contract is a standardized agreement to buy or sell 5,000 ounces of silver at a specified price at a future date. Most participants never intend to take delivery of the metal. Instead, they trade contracts to speculate on price movements, hedge risk, or manage exposure. The key feature of futures trading is leverage. Traders do not pay for the full value of the silver up front. Instead, they post margin, essentially a good faith deposit, to cover potential losses from daily price fluctuations. This allows traders to control large positions with relatively small amounts of capital. Leverage magnifies both gains and losses. A small price move in silver can result in large percentage gains or losses for leveraged traders. This dynamic attracts speculators but also introduces instability, especially during periods of heightened volatility. Because futures markets are deeply liquid and heavily traded, they play a dominant role in price discovery. Spot prices are often derived from futures prices, even though the majority of futures contracts never result in physical delivery. This means that paper trading activity can have an outsized influence on prices seen by physical buyers and sellers. When prices rise rapidly, leverage tends to increase. Traders add positions, momentum builds, and open interest expands. However, this leverage is fragile. It depends on traders' ability to meet margin requirements and tolerate volatility. Any increase in margin or sharp adverse price move can force rapid deleveraging. This structure explains why silver often experiences explosive rallies followed by sudden corrections. The metal's relatively small market size compared to other commodities makes it particularly sensitive to leveraged flows. When sentiment shifts or conditions tighten, the adjustment can be swift. Importantly, futures markets are not inherently flawed. They serve legitimate purposes and provide liquidity. But their influence means that short-term price movements often reflect trading dynamics rather than changes in physical supply or demand. For physical silver holders, this distinction is critical. Futures leverage explains why prices can swing violently without corresponding changes in availability at coin shops or refiners. The paper market moves first, the physical market reacts later if at all. 4. Why margin hikes create sharp, short-term drops. Margin hikes act as a pressure valve on leveraged markets. When volatility increases, exchanges raise margin requirements to protect the integrity of the system. This reduces leverage and forces participants to reassess risk. In a fast-moving market, margin hikes can trigger forced selling. Traders who lack additional capital must close positions, often at unfavorable prices. This selling is not discretionary, it is mechanical. Positions are liquidated not because traders believe prices will fall, but because they cannot maintain exposure under new requirements. This dynamic creates sharp, short-term drops. Selling clusters around margin announcements, liquidity thins and price declines accelerate. Once the selling is complete, prices often stabilize, sometimes quickly. Such drops are often misinterpreted as evidence of manipulation or collapsing fundamentals. In reality, they reflect the mechanics of leveraged markets adjusting to new constraints. Importantly, margin hikes reduce systemic risk. By lowering leverage, they make markets more resilient. While the short-term impact may be painful, the long-term effect is often healthier price discovery. For silver, margin-driven sell-offs are a recurring feature. They tend to occur after strong rallies and rarely alter the underlying trend. Understanding this helps separate noise from signal. 5. Paper market activity versus physical silver reality. One of the most persistent sources of frustration among silver holders is the disconnect between paper market activity and physical reality. Large volumes of silver can be sold in minutes without a single ounce changing hands physically. Paper silver exists in futures contracts, options, and other derivatives. Physical silver exists as bars, coins, and industrial inputs. While paper markets influence pricing, they do not directly reflect physical availability. During the recent pullback, tens of millions of ounces worth of contracts traded rapidly. This did not mean that warehouses were flooded with silver. It meant that positions were transferred, closed, or offset on screens. Physical markets operate differently. Supply chains move slowly. Refining, minting, shipping, and retail distribution cannot respond instantly to price changes. Premiums, availability, and delivery times often tell a different story than spot prices. For long-term holders, this distinction is liberating. Short-term paper volatility does not alter the amount of metal they own. It does not erase ounces from a safe or vault. It simply changes the quoted price. Understanding this helps maintain perspective. Paper markets are noisy. Physical ownership is quiet. 6. The long-term case for holding physical silver. The case for holding physical silver is not about daily price movements. It is about long-term monetary integrity, diversification, and protection against systemic risk. Silver has served as money for thousands of years. Unlike fiat currency, it cannot be created at will. Its supply grows slowly and at significant cost. This scarcity underpins its role as a store of value. In an environment of persistent deficits, expanding debt, and monetary debasement, physical assets offer an alternative. Silver's dual role as monetary metal and industrial input adds resilience. Physical silver carries no counterparty risk. It does not depend on a promise, contract, or clearinghouse. This independence is central to its appeal. For those who hold silver with this mindset, short-term volatility is secondary. The focus is on accumulation, preservation, and long-term purchasing power. 7. Inflation, purchasing power, and nominal highs. Much of the excitement around silver's recent highs centers on nominal prices. However, nominal highs do not tell the full story. Inflation erodes purchasing power over time. A dollar today buys far less than it did a decade ago. When prices are adjusted for inflation, silver has not yet reached its true historical peak. This distinction matters. It suggests that recent price levels, while high in nominal terms, may still undervalue silver relative to the decline in currency value. Inflation-adjusted analysis reframes the debate. It shifts focus from short-term milestones to long-term monetary trends. What this means for ongoing stackers. For ongoing stackers, the current environment creates mixed emotions. Rising prices validate the long-held belief that silver is undervalued. At the same time, higher prices reduce affordability. Those still accumulating must reconcile these opposing forces. The solution is perspective. Stacking is a long-term process, not a race. Short-term pullbacks, especially those driven by paper market mechanics, may offer opportunities. More importantly, they do not invalidate the broader thesis. Ultimately, stacking is about ounces, not headlines. Understanding the forces behind volatility helps maintain discipline and conviction through every cycle.